seen growth figures come in lower. The Atlanta Fed has a tool called FedNow, which is a more accurate tool for predicting and noting the forecast for economic growth, more factors than some of the other data sets out there. And they'd already concluded it was going to be slower growth. So that in itself, that the Fed then turned around and said, yes, we are actually going to experience slower growth in 2025, was not shocking. And in fact, I think growth could still slow from that 1.7% prediction if we continue to have this tariff uncertainty, and if what's already been sort of baked into the cake of the uncertainty that we've experienced continues to fester. So that's one thing. The fact that the Fed also raised its inflation prediction, again, for the same reasons, we've been looking at inflation figures that are going to hover in that high 2.5, 2.8, maybe even touch 2.9 or 3.0 level. The issue here is that the Fed seems to think it can actually stick a landing of inflation down to some magical 2% number, when the fact is there are so many supply chain, geopolitical, and other reasons why inflation is what inflation is at any given moment. And the Fed really can't do that. But what was interesting about the meeting was that the Fed was sort of pivoting from that language about the bravado of fighting inflation to, it's kind of still there. And yes, it's increasing, but also we're focusing on lower growth, which is what makes sense. They should have been doing this. So I think what they're doing in their language is massaging that ability to be able to reduce rates by more than they had forecast in December of last year. They forecast 50 basis points of cuts for this year. The expectations on FedWatch are that could be between 50 and 75 basis points. I think it could be as high as 1 full point. And that's also because we are seeing growth slowing. Inflation's going to be there, and the Fed's going to have to come to terms at some point with the fact that it can't get that 2% just because it wants to. So one of the major signs is the debt overhang that we're looking at. Obviously, we have a massive amount of debt at the government level, 36 trillion and counting, as we speak. That's one element. And what that means is the government, regardless of what it cuts, doesn't cut, whatever the efficiencies are, is that it has to pay somewhere between $880 billion to $1 trillion a year in interest rate payments just to get in to keep the lights on. That's a massive overhang. But if you drill down with that to the small business level, the consumer level, we are seeing that at every level along the way, there are record amounts of debt at higher rates, at higher costs than there have been in many, many years. And that's a direct result from the increase in interest rates that we've seen since 2022. And obviously last year there was a reduction of 100 basis points in those rates, but the overhang is still there. And so what you have is this meeting of inflation on lots of levels that hasn't gone away. And even if it's slowed down a bit, prices are still rising. It doesn't mean that prices don't still rise. And you have debt overhang at interest rate levels that aren't coming down fast enough. And that creates a real wear and tear on the economy. We've seen that in confidence levels going down. We've seen that in production levels going down, manufacturing going down recently in some of the most recent statistics. What that is that wear and tear of that meeting between debt to grow or debt to survive versus the cost of that debt. And that's going to have an impact on the economy, as well, of course, uncertainty. So right now, of course, we're in the middle of not knowing what's actually going to happen with respect to tariffs between the US and other countries, what's going to stick, what isn't, what negotiations are going to happen beneath the surface. All of that uncertainty also hangs on the economy. It makes growth projections and strategies and forecasts for companies a lot harder, and therefore there's more hesitation, and that hesitation means the economy is not growing while that hesitation exists. So all of these elements really contribute to a slowing down of the economy. Yeah, those are all real and visceral elements to, how the consumer mindset is pivoting. When we see, for example, that restaurant frequency has gone down overall, but the restaurant frequency that people are still doing is turning towards casual restaurant experiences and cheaper restaurant, fast food type experiences to still socialize, but not the middle to higher end. So all of these little tweaks are what consumers are doing naturally. And then when you aggregate that up through the entire country, that's where we see it impacting the full economy. So, for example, even grocery store purchases, right? We know that the price of eggs is very high. We know that if you have tariffs, the price of avocados is going to go high. There's various things that happen, but all of them contribute to an overall grocery checkout experience. I think this is what we're seeing in the numbers in terms of the cost of groceries. Just an average basket of groceries is still increasing by more than the average rate of inflation. So people are seeing it in their food purchasing. And if it's happening in your food purchasing, the things that are basic needs, again, you extrapolate that and you start to tighten your belt along everything else. And that's where you get up to Delta and American, all the airlines saying, look, people aren't spending what they are on travel that they used to, because what can go? If you need to feed your family, first, what goes out of the grocery basket? And then if you don't need to travel, what do you economize on? What do you minimize? And all of these choices have a contracting result on the overall economy. And that is what we're seeing. People just buying less, deciding not to buy items that aren't even necessarily luxury, but are just simple choices along a food chain as to what is purchased and how the experience is, more eat at home versus restaurants and so forth. So all of that has an impact. And then it has an impact on the industries that supply any of that, whether, it is the restaurant industry, whether it's a midstream seafood experience. I actually just spoke at a global seafood conference in Boston a week or so ago. And the major fear of domestic North American and global companies throughout the seafood chain, that's the sort of getting of the food to transporting to putting in restaurants. There are concerns about the uncertainty of tariffs and the consumer preferences. So then they start cutting back what they supply, but they also increase their prices at the same time because they're trying to make ends meet, and that has a bigger squeeze on the consumer. So all of these factors have an impact down the economy line. Everybody will see in their own thing. When I went to just our local Ralph's in LA and I bought what I thought was 5 things and it was $83, right? And I checked out, and as I was doing that, I asked the woman at the checkout counter, I'm like, has anybody, literally anybody, come in here and bought stuff for less than $50? And she's like, no, they're not. Like, everyone's economizing on their decisions and still walking out to the best of their economic abilities with a high tab. And then regular feed a family, people are walking out with, carts that are just way beyond what they would have thought they would have to pay. And so, yeah, what you're seeing on any product level, you aggregate that up, people have to make decisions. That's what we're seeing right now. You couple that with debt. You couple that with the fact that consumers experiencing record household, credit card, auto loan payments on debt, not even just the level, but the payments, like we were saying before, and that has an impact as well. That squeezes the consumer. Wall Street is trying to do a couple of different things. They want the Fed to cut rates because that gives them the opportunity to use cheaper money to speculate more, to encourage more deals with corporate customers and so forth, because the cheaper that money is, the more ability Wall Street has from an investment banking standpoint to do more deals at those cheaper levels, or to use the cheaper levels as an incentive to push more deals, which is what the larger banks on Wall Street do and why these bonuses are so high, because they started to do that last year as rates were being cut. On the other side, they're not being cut fast enough. And so what's happening is Wall Street is sitting on a set of unrealized losses, meaning they're just book losses right now of $620 billion and rising very rapidly of unrealized loan losses. And what that means is they have loans on their books. These are in commercial mortgages, these are in corporate loans, these are in some consumer loans, but for most part, commercial and corporate loans are hemorrhaging, where the delinquency values are up to pre-financial crisis of 2008 levels, and where they haven't had yet to book the losses. But the losses are growing. So that's like a ticking time bomb for Wall Street. And the more that they can use the Fed's knowledge of this to push for lower rates, the easier it will be for them to restructure some of these loans at those cheaper rates and sort of extend the problem out. It doesn't mean the problem goes away. It doesn't mean these loan losses won't grow, but it means that they can restructure some of these loans at lower interest rates, make money on the restructuring, so banks some money themselves, and also for themselves borrow money more cheaply from the Fed in order to grow and speculate and whatever else they do. So they're in a position where they're losing money, they're not booking it, and they want cheaper money to be able to go about their business more sort of freely. That's a concern. I mean, we did see a number of banks fail in early 2023, including Silicon Valley. And the problem with what's happening now is there's no obvious one bank that's going to go under. It's sort of a pan across mid-level banks that does connect into the larger banks. That's one reason reason why Bank of America's CEO Moynihan was very specific about suggesting that there's a connection between economic slowdown and rates without saying, oh, you need to cut rates specifically publicly to the Fed. But a lot of these conversations happen behind the scenes. And going back to what we were saying before, that's one of the reasons Powell is pivoting to, let's look at this economic growth slowdown as a potential reason to save face with the fact that they're probably going to cut rates by more than they said because of these bank problems. Add that one final thing. The Fed itself has a book of $6.7 trillion worth of assets, which are U.S. Treasuries, and mortgage securities, which are linked to the 10-year, as you said, in U.S. Treasuries and sort of the middle part of the U.S. Treasury curve, which banks pledge to them in reserve or which they've bought through their quantitative easing programs in the past. They buy bonds, they give money to the banks. Well, they remit the interest on that money to the Treasury Department, or a portion of it. They are at a record loss and shortfall of the amount that they're remitting to the Treasury Department of $250 billion, right? And that's growing. So no bank, including the Fed, is really doing well with where things are.